Ladies and gentlemen, a very warm welcome. My name is Nawied Jabarkhyl and I'll be the moderator for today's webinar titled 2025 Energy Wrap-Up and 2026 Outlook, hosted by the Al-Attiyah Foundation in partnership with LSEG Data and Analytics. Now, before we get started, I just wanted to go over a few housekeeping rules for the discussion to make things a little smoother for you. First up, for the best viewing experience, please read the instructions above the media player. If you face any technical issues during the webinar, please try refreshing the page or reaching out via issuerservices@lseg.com. For any questions for our speakers, this is an interactive session. You can click on Ask a Question. Please note, in the interest of time, though, we may be unable to address all of the questions with the speakers, but we'll try our best to get as many of them in for you. During the session, you'll also be participating in polling questions. I'll ask those and then you'll have a pop-up to answer what you think is the most important factor. And lastly, the recording of this session will be available using the same event link. Now, as 2025 draws to a close, the global energy and climate agenda stands at a crucial inflection point. Markets have endured geopolitical shocks, technological breakthroughs, and mounting pressure for climate action, while governments and businesses, they still face urgent demands to meet sustainability goals. Despite those headwinds, global energy investment is set to reach a record $3.3 trillion this year, with clean energy attracting twice the capital of fossil fuels. Let's look at some of the key indicators shaping energy markets. Natural gas, we'll start there. Demand around the world is slowing down, but still growing, growth of around 1.5% this year, weighed down that market by economic uncertainty, high LNG prices, and cautious consumption in price-sensitive markets. Supply delays aren't helping, particularly in the United States, and rapid uptake of renewables are tightening global balances, driving volatility as well as price swings. The outlook isn't that bad, though. The IEA, International Energy Agency, expects demand to rebound next year as new supply from the likes of the US, Canada, and Qatar surge by 7%, easing some of the tightness and potentially a revival of Asian consumption as well. In contrast, though, oil markets heading towards a record surplus in 2026 as supply continues to outpace demand, having a major impact on the Middle East in particular, with Brent crude potentially sliding towards $51 a barrel. That's according to the US's Energy Information Administration. Trade tensions, well, those have been well documented, as well as weak economic signals around the world holding down demand growth throughout this year. And OPEC Plus's rollback of production cuts have pushed prices to 4-year lows. We'll delve into where they might be heading later. Yet from a capital perspective, strangely, the Middle East is drawing record levels of upstream investment, highlighting a potential mismatch, if you like, between today's oversupply and longer-term energy security concerns. Low carbon technologies, momentum there was slightly mixed over the past year. Carbon capture, utilization and storage gained some ground with landmark projects in Norway and the US announced. With over 50 million tons of capacity in operation, the technology is also approaching a critical juncture. But there remain concerns, the likes of cost, regulatory concerns, and infrastructure hurdles still limiting deployment. Hydrogen, another hot topic. Developments were a bit more uneven this year. While some flagship projects advanced, many encountered delays or cancellations due to cost challenges. And then, of course, renewables, the rally there goes on. Renewables will meet nearly all additional electricity demand in 2025, overtaking coal as the world's largest power source and strengthening the case for cost-competitive clean energy in climate negotiations. And last, what about financing? Well, carbon pricing remains a central policy instrument this year, with the EU refining its mechanisms with some potential geopolitical blowback there, China asserting leadership among emerging economies, and Southeast Asia advancing regional cooperation in the area. At the same time, sustainable finance is scaling rapidly. If you look at what the figures say, global ESG assets projected to reach $34 trillion by next year. That's over a fifth of total assets under management. That's despite, of course, the recent rhetorical pushback, at least we've seen in some markets under President Trump, most notably in the United States with his return to the White House. Plenty to unpack then, and this webinar will shed some light on some of those key developments this year and crucially look ahead. Our expert panel will explore what 2026 may bring by connecting the lessons from 2025 with forward-looking insights for next year. The session should hopefully equip industry leaders, policymakers, and stakeholders with the tools to navigate uncertainty while advancing energy security and climate goals. Well, I mentioned the expert panel. Without further ado, I'd like to introduce the speakers for today's session. We've got Andreas Kyrilis, Senior Partner at Bain & Company. Faysal Taher is Partner, Energy Transition and Climate Investments at Boston Consulting Group. Giles Farrer is Vice President, Head of Gas and LNG Assets Research at Wood Mackenzie. Norela Constantinescu is Acting Director of the IRENA Innovation Technology Centre. And last but by no means least, Paula Van Laningham, Director, Carbon Research at the LSEG Data and Analytics team, who'll shortly guide us through a presentation to kick things off and set the stage for today's very engaging discussion. Paula, over to you.
Thank you so much, Naweed. If we could bring up the slide deck, please, that would be great. As noted, my name is Paula Van Laningham. I am the Director of Carbon Research at LSEG, so I overlook all of our coverage on the carbon markets, which includes a wide variety of them. If we could bring the slides forward, please. So, carbon pricing has continued to grow over the course of the last year. It's becoming an increasingly prevalent part of the conversation around decarbonization. We view it primarily as a financing tool. It's one way to do that, but it has a variety of different aspects which make it effective at fueling decarbonization across different industries. It does it primarily in four different ways. For one thing, it creates cost incentives by providing price signals regarding a failure to decarbonize. This is particularly important when you're talking about very difficult to decarbonize industries where you need to have that price signal in order to drive that innovation and investment. It is very good at targeting industries as well. We'll talk about this in a minute, but really carbon pricing is very effective at driving decarbonization in those most difficult to decarbonize spaces, again, by providing those cost incentives and price signals. It also creates revenue incentives and financing, which of course makes it a key component of the overall green economy potentially as well. Certain markets can provide additional revenue streams for decarbonization. So this is something that you see right now with industries and or entities that are covered by carbon markets. They're able to sell on their allowances or credits to markets that are not decarbonizing quite as quickly, thus creating an additional revenue stream. And then fourthly, and perhaps very critically, I think in the conversation around CBAM, it actually provides standardization around the discussion for carbon intensity. Historically, when we have talked about decarbonization, we talk about it with different boundaries, with different rules. And this, when you kind of create a standardized system through carbon pricing, you're able to create a standardization so that everybody is essentially using the same spreadsheet to measure their overall carbon intensity, and thus making it easier to measure actual progress over time. Next slide, please. Over the course of the last couple of years and forecasted out to 2030, we are going to see an increasingly large volume of the global emissions covered by carbon pricing. This is not to say that this will cut down on all of these emissions because, of course, carbon markets allow some level of continued emitting, but the idea is that these levels are gradually tightened over time in order to drive decarbonization. And what you can see is that the addition of the China ETS power markets in particular saw a big jump in the amount of emissions coverage. That's going to continue as new industries have been added into this compliance cycle, and additional markets will be added moving forward as well to cover quite a wide volume of the overall global emissions. These will be decarbonizing at different rates. So in the EU has a fairly ambitious target, albeit slightly less ambitious than it was, potentially slightly less ambitious than it was before. We will see how that actually is decided. But what you can see is that these markets are continuing to expand pretty dramatically and will cover a significant amount of the actual global emissions over the course of the next 10 years, 5 to 10 years. Next slide, please. The Paris Agreement has been a big driver of this, as has the EU's carbon border adjustment mechanism has been driving additional focus on carbon markets domestically. So you have some first mover markets. So this would be the EU, New Zealand, West Coast WCI, which is California and Quebec. But you've seen a real growth in additional markets as they've expanded out. So China is the really big notable one. The Chinese ETS, which was launched several years ago, is now expanding beyond power to include aluminum, iron, and steel. And so those are also going to see growth as well. You're going to see additional lower emerging market economies are also developing new carbon markets. This is kind of twofold. It's both related to the introduction of CBAM, which may see some modifications as it kind of actually takes effect. But it's also related to the agreement, the Paris Climate Agreement. And so this is going to drive a lot of the decarbonization within individual countries' border in order to meet their own nationally determined contribution obligations. These markets themselves will differ in their construction as well. So some of them are focused on carbon intensity. Some of them are focused on an overall emissions cap. Some of them use allowances. Allowances are where a market is every unit looks like every other unit. You have a finite number and you gradually tighten that over time. Some of these will be based in credits. So that's going to be something that is going to be a major source of conversation around particularly credit quality and the often thrown about word about credit integrity, which is the idea that a 1 metric ton of carbon dioxide equivalent will actually result in a reduction or avoidance of 1 metric ton of carbon dioxide equivalent. Next slide, please. Carbon credits have been an extremely challenging area, particularly in the voluntary carbon market, but they are going to set to play an increasing role as we talk about carbon markets globally, both through the Paris Climate Agreement under Article 6, but also within these domestic markets as well. The big question around carbon credits has been around market credibility. Credibility only really works for credits if both the supply of and demand for credits is considered to be credible. So that's the idea that you're both actually resulting in emissions reductions every time you use a credit, but then also at the same time, what you're using it for is a good way to actually use that credit, as opposed to potentially using it for something and not actually driving real emissions reductions. There have been a growing number of standards bodies looking at this in order to kind of create standardized rules around this, particularly in the voluntary market. So you have the ICVCM, which is a standard body that looks at the supply, while the Science-Based Target Initiative and the VCMI look at demand. So they are trying to structure this in the voluntary space. Within Article 6, credit standardization will be managed directly by the Paris Agreement crediting mechanism. So that's the idea that you would have specific types of credits that would be permitted for use. And that's one way to ensure that the market is actually doing what it's supposed to do. That said, most markets are continuing to coalesce around the idea of Article 6 alignment, even in voluntary markets. And so this primarily focuses on host country authorization. So to make sure that those carbon credits are actually meeting the requirements of the host country governments themselves, that's considered to be a marker of quality to ensure that you're actually getting what you, that you're not sort of getting something that is potentially violating local sovereignty rights. And then also that there is a corresponding adjustment. And so that means that the global balance is actually kind of kept whole. So if a credit is exported from one country, then that country's balance is offset and it's added to a different country. Both CORSIA and Article 6 Paris Agreement crediting mechanism has been slow to approve methodologies. Now that there's been this big focus on quality, it tends to become, it means that actual additions in terms of methodologies has been very slow to be added to this market. And so that has actually contributed to really a slowdown, not necessarily in the adoption of carbon credit markets themselves, but has continued to kind of halt the growth, I think, at rates that were expected, 3 to 4 years ago. Next slide, please. That said, again, they're a financing mechanism. And generally speaking, the global green economy has continued to grow quite significantly across a wide variety of different industries, particularly in energy. What we've seen is that it's more than doubled to 5.1 trillion in our own global equities coverage. And of course, that's only part of it. Green economy industries can really cross a lot of different assets. So that's partly what this is. But you can see that when you actually add in the green economy side of things, it's only actually second to technology overall. Again, because the green economy really transcends traditional boundaries around industry. It means that you can actually get quite a lot of significant and a wide array of different areas. So that is sort of the end of my presentation. I will just transition over back to Nawied and we will talk through the panel. Thank you all very much.
Thank you, Paula. Very insightful there, and we'll delve into a bit more of what you outlined later on in the webinar. Before we move further, we'll go on to our first poll question. This is a chance for you watching to get involved as well and let us know your thoughts. The first question we've got for you is, which factor will have the biggest impact on global energy markets in 2026? Which factor will have the biggest impact on global energy markets next year? You think it's A, surging LNG supply, or B, oil market oversupply, renewables growth, or the geopolitical risks that seem to be ever present today? Let us know what you think. You have the opportunity to answer that, and we'll come back with the answers in just a moment. As we do, I'm going to start off the discussion then. If it's okay, Faysal, I'll come to you first. Looking at clean energy, that's one of the options on there. Investment accelerating amid slowing global growth. We're still seeing, as I mentioned in the introduction, a lot of money going into this. Can the world sustain the sorts of investment needed for the energy transition, especially for poorer nations where their priorities may lie elsewhere? Faysal?
Yeah, thanks, Naveed, and thanks for the question. I think important here to think of the scale of the investment challenge. The current clean energy investments are around 2 trillion a year. And to achieve the long-term climate goals, the annual investments need to reach something like double, 4 to 5 trillion a year. So there's a big gap there. And another part of this is that most of the incremental demand for renewables, for clean electricity, etc., is coming from emerging and developing economies. Yeah, so you have a gap in the amount of investments, and where it needs to go is very concentrated. Okay, so why are the emerging economies struggling to attract the capital? The issue here is a number of things. One is the higher cost of capital. These countries are perceived to have high sovereign risk. So the same project in a developed economy can be 2 or 3 times less than that in a developing economy. Another element is around the policy frameworks. Investors don't have confidence in the policy frameworks in these countries. So long-term PPAs or the predictability of regulation, they don't hold as much predictability in emerging economies. Another element also is the project pipelines. A lot of the pipelines are very much in the concept level of development. There aren't a lot of or consistent level of bankable projects. And this is a big obstacle to attracting investment. So considering this context and the challenges of the emerging economies, the question comes to what would unlock investment at scale in emerging economies? Blended finance continues to be a very meaningful contributor. Here, with things like first loss capital by multilateral development banks or development finance institutions, political risk guarantees, or even currency hedging in some countries can play a big role. Another unlock is around standardized and replicable project structures. We've seen this work very well in LNG and telecom. So having these standard PPA frameworks, risk-sharing frameworks can really give more certainty and confidence for investments. And the third one I want to highlight is around the transition finance. So a lot of the emerging economies need to go through conventional power to grow their economies. They can't go straight into renewables. So that means that instead of going to pure green financing, they need to go into a transition financing. So they need capital for emissions-intensive sectors that are tied to credible decarbonization pathways and accessing sustainable linked instruments and so on. So I think these are three important mechanisms I'd highlight to help unlock investment in growing economies. So if I just close with one summary statement here, it's that it's less about the having enough money. It's more about affordability, managing the risk in these emerging economies. Sorry, go ahead, Nawied.
No, thank you, Faysal. Really important points there. I wanted to share the results of the first poll, which surprising. It's funny when we do these webinars, it's surprising what you think would be the response and what actually is. So surging LNG supply, the biggest impact on global energy markets. None of you thought that would be the most important factor. Similarly, oil market oversupply. None of you thought that would be the most important factor. Instead, there was an even split between renewables growth and geopolitical risks. I'm going to pick up on some of the points you made, Faysal, with Irina in a second. But Giles, I just wanted to come to you first, because as I outlined, LNG and gas is growing well. We hear about the cost concerns in developing countries and emerging markets. But are you surprised that nobody thought surging LNG supply would be the most important impact? And what role does gas have to play in the transition moving forward, do you think?
No, I'm not surprised. I mean, because I would have it as geopolitical risk, I think, as being the most important factor, and understanding particularly what is happening around the peace process and the potential ending of the Russia-Ukraine war has immense implications for both gas markets and oil markets. In that, if we were to see a conclusion of that, a peace settlement there, which would start to allow Russian volumes back into the market, then I think you would see downward price pressure in already quite bearish markets, I think, on both the oil side and the gas side. But if you don't see the current peace efforts move towards a settlement, then I think it's possible you're going to see further sanctions, and that has the potential to keep these markets a little bit tighter. And so for us, that is the kind of the big questions within the markets, and given the events of the last few years, further risk around events has potential to add additional uncertainty to the energy market outlook. So LNG supply, much as it is kind of my sort of key area of focus, I don't think it's the biggest factor in the global energy mix. But with regards to the gas market, I mean, it is one of the defining features of what is of how that market is reshaping. If you look at forwards, we're seeing forward prices on the TTF and on JKM, the Japanese spot pricing is coming down, and that is in response to growth in LNG supply in the market. And what we will look to understand is the extent to which we start seeing additional demand growth come through at lower prices, and how that plays out.
Great. Before we go on to our next poll question, Norela, I wanted to come back to you on the issue of renewables, the third option there, which also had 50% of people thinking it would be the most important factor on global energy markets. Just give us a sense of, Faysal touched upon there, the challenges for emerging markets. When you're looking at the work that IRENA does, obviously a global organization, what specifically, Faysal touched on blended finance, policy frameworks, what specifically do you think is needed to try and overcome the challenges of widening renewables adoption, even though it is growing significantly?
So thank you. First of all, indeed, renewables actually in 2024 increased and totalized 582 gigawatt, which represented almost 90% of the capacity in the power sector. this is mainly due to decrease of levelized cost of electricity. And in general, what we see in our analysis last year is that almost 90% of the costs in renewables, they were cheaper than actually oil and gas or coal, the cheapest version of these projects. Of course, we talk here about the levelized cost of electricity, so we do not talk about also taking into account the integration costs. Now, in terms of where these renewables they were deployed, I have to say that 90% of them they were in developed countries and China, so only very little in emerging markets and developing countries. So therefore, we have to shift, and it was mentioned previously by the other speakers. So there are the risk associated and the cost associated actually with this deployment. When we looked at the cost of capital, and we pull this together with the levelized cost of electricity. Actually, for example, Africa and Europe, they have the same costs. Of course, the resources and the technology as such, because it's imported, so will be cheaper in Africa, but the cost of capital, it's so high that actually we reach the same point as in Europe. In our assessments, what we mention is that, of course, as a solution, may be scaled up to this concessional finance, which will actually support the reduction and the risk which is associated with the cost of capital. I think these blended structures were mentioned before, as well as the guarantees, which can give actually an opportunity for long-term investors to look also into these markets. But what is the most also important, and where we worked as IRENA, was around the regulatory and actually investment frameworks which support the countries in the global south, as we call them, so to make the frameworks more stable in order to allow the reduction of the cost of capital, and of course to work with the international financial institutions towards these developments.
Thank you, Norela, for outlining the significant tools, I guess, to try and widen adoption to parts of the world that need it most. And I think we've seen once again in recent days and over the past week the impact of climate change on certain parts of the world. If you look at Indonesia and the flooding there, or all the way up until Sri Lanka as well. So definite need amongst adaptation and mitigation financing in parts of the world. I just wanted to go on to low carbon technologies for a second. Andreas, if I can come to you. They had a bit of a mixed picture, as I said in the introduction, the likes of carbon capture, utilization of storage, or hydrogen being used by certain economies. If you look at Oman in the Middle East, investing heavily there, but the results at the moment not really very clear, and still some trouble with trying to increase these when it comes to projects at scale. What role do you think they'll play in the energy transition next year?
No, I think low carbon technology and energy efficiency abatement still stay at the I would say at high the agenda of most of the companies that we see around the world. So we do expect broadly decarbonization and especially operational efficiency, energy efficiency to be one of the main levers to continue. Although the way the world is shaping, we do see some tampering on these efforts, and I would say even more so an emphasis on high return initiatives, so much higher level of scrutiny when it comes to initiatives focused on operations and upgrades. At the same time, when it comes to technologies that are more, I would say that require more time in order to mature, be it carbon capture or hydrogen, we do see a much higher level of scrutiny than we have before. There is a strong emphasis again on what is tried and tested. We do expect the broader, or I do see the broader hydrogen agenda taking a bit of a longer path to fruition, much higher level of scrutiny on investments. And when it comes to carbon capture projects, we do expect them to continue. I do see them continuing in pace, but again under the same umbrella of scrutiny with respect to ROI and very high focus on securing storage first before proceeding investment, which is something that you would consider, of course, natural, but in the previous years had seen a much more bullish approach towards investigating or applying or moving to pushing forward projects without having secured the storage yet.
And that's a key issue, I think, not just for hydrogen, but for other parts of the low carbon technology space as well, and even in renewables, which we will discuss later on. I just wanted to open, that was a perfect segue into the second poll question for our audience. The second one is going to focus on clean hydrogen, so hopefully it will pop up in a second. And the question is, where do you think clean hydrogen will find its strongest foothold by 2030? So a nascent but growing technology, as we've just been hearing there, but still some challenges it's facing. Where do you think clean hydrogen will find its strongest foothold by the end of this decade? Industrial applications in power generation and storage, transport, or limited uptake across all sectors, which seems to be a potential likelihood as well. I'm just going to come back to you, if I may, Andreas, because one thing you said there jumped out at me. There's a strong emphasis on what's tried and tested. When you're talking to CEOs or global energy firms and they're looking at investment, there is investment going into the industry now. Where are they prioritizing the money when they're tying up capital?
Yes. So definitely differentiating between own decarbonization and let's say investments in market investments, so to speak, in the broader energy space is something definitely differentiate. Again, when it comes to own decarbonization, renewed focus on high return initiatives, renewed focus on energy efficiency, and projects were related mostly to hydrogen or carbon capture. I would say I wouldn't use the word delayed, but definitely seen as with much higher scrutiny. Now, when it comes to the broader, let's say, to competing in the broader new energy space, definitely one would see that the expecting a world with a high speed of energy transition is something that has changed in the perspective of most of the energy players. Of course, all of the players continue to be present or continue the renewables agenda, or the ones who have started. But at the same time, we do see a renewed inspection or a renewed view on the hydrocarbon portfolio, and I would say, broadly speaking, the molecule. As returns in renewables have started easing down across a number of different markets, we do see companies start looking inward again in the hydrocarbon portfolio, see how they can increase the exposure, especially when it comes to gas and LNG, which has become increasingly relevant in the current geopolitical environment, be it Europe or of course, or also the new Asian markets that are coming on stream when it comes to LNG. But also at the same time, we see a very high focus on the biofuels agenda, both as part of the regulatory evolution that is coming over the next 10 years, but at the same time as being a close complementary part, especially of the oil and gas players' portfolio. We haven't seen a concrete, let's say, business model that is winning so far, but definitely what I see is a high level of activity and interest about the role that the molecule rather than the electron will also play a role in the agenda.
Thank you very much, Andreas. We've got the answers in for the second poll. And C, transport, nobody thought that would be where clean hydrogen will find its strongest foothold. About 1 in 5 thought power generation and storage, same, about 17%, limited uptake across all sectors, but nearly 7 in 10 thought industrial applications would be where clean hydrogen finds its strongest foothold. Paula, if I can come to you, you outlined in your presentation there that heavy industry may have to incorporate some of these changes. The results there suggest that clean hydrogen could be one factor, but I just wanted to get your thoughts on what urgent steps industries need to take to try and align those near-term energy strategies with the long-term climate goals that lots of businesses and governments are looking at.
I think what is very clear when you look at some of the more well-established carbon markets is just at what level of carbon price you kind of need to drive decarbonization in some of the very, very hard to decarbonize sectors. So that I'm really thinking about things like cement and chemicals here, where you require quite a lot of very energy intensive things that don't really work with renewables the same way. And so when you're actually looking at kind of the cost to decarbonize on a lot of that in those markets, you're looking at something like a 200 euro per ton carbon price to really drive decarbonization in the clinker sector in cement, for example. And so that's just an example of one of them. Obviously, each industry and each region sort of has their own prices. And that's really one of those areas where sort of these very, very, very sort of not nascent, but still underdeveloped clean technologies are going to be really critical to drive decarbonization as part of that. Clean hydrogen, I think, is going to be a really clear one for industrial applications, but it's really something that is going to you're going to have to sort of start planning ahead, particularly because if you're talking about these markets where these are being implemented and tightened quite quickly. Europe is the really obvious case there, but obviously the implications of CBAM means that a lot of these industries abroad are also going to have these decarbonization pressures. You're really going to have to start looking at investment, I think, before you hit that 200 euro per ton mark, right? Because these things take time to build and to integrate into the industrial process. And what is very clear, I think, that the EU ETS has really shown is that decarbonization at that level is expensive, and it's going to continue to be a challenge.
And thanks. I'm going to come back and talk about carbon pricing and the other aspect of your presentation as well towards the end of this. I wanted to zoom back into renewables for a second, and we'll bring up our third poll question if we can, because this is a really important one. As we heard, a lot of new energy generation is coming from renewables, outpacing coal at the moment. So the next question we've got for you is, which challenge is the most urgent for renewable integration next year in 2026? What's the most urgent challenge? Is it grid flexibility, energy storage deployment, financing and investment, which we've heard a bit about from some of our speakers already, or permitting and siting delays? So if you can let us know what the answer is to that. Norela, I'm going to come to you with that question if I may. I think people would have made their minds up now. So what do you see as the most urgent challenge for renewables? A lot of the new investment, as you say, in China and a few countries. What do you see as the main challenge to widening adoption in the places needed?
Thank you, Nawied. I think I mentioned already. So what we see actually as probably the most challenging and how to say, the different development stage, it's of course the integration challenge. And when I say the integration, it's of course the integration into the grid itself. So the renewables were promoted and they were deployed faster. It's easy also as timelines. So the lead timelines for the renewables. While the grids, and I would, because I am coming from Europe, including in Europe, they were not in the focus, and of course these developments, they take quite a lot of time. So we are looking at maybe 10 years lead times. So this is the most challenging part. At the same time, because 90% of these renewables are actually, which were deployed, are variable renewables, so wind and solar. So we need indeed to combine the development of the grid with the flexibility. The grid can give flexibility, but we look at a portfolio of solutions, so storage, of course, short duration like batteries, but also long duration, depending on the energy mix you have. So if it is wind, then also longer time duration storage is needed, have to be taken into account in this development. And of course, the investments and the permitting are important. Permitting, I think, for the grid integration, it's very relevant. But I'm curious to see what the answers will be. So for me, the most important is actually to focus on the grid and on the flexibility in the next years.
Thank you. And we've got the answers, and they're a bit more split this time round. I think people are a bit more undecided in terms of which was the clear winner here. Grid flexibility, that was 20% thought that would be the biggest challenge. Similarly, 20% thought financing and investment, and another 20% thought permitting and siting delays. 40%, 4 in 10 thinking energy storage deployment would be the biggest factor. Faysal, I'm just going to come to you with that, because we're seeing billions and hundreds of billions being pumped into energy, data storage, AI, driving this so-called energy for AI and AI for energy outlook, being driven largely by a lot of sovereign wealth as well here in the Middle East. Just give us your sense on where that's heading and what impact you think that will have on 2026. Because if you look at the US and its GDP, very much driven by the market and these major companies, especially AI firms and tech firms powering forward with AI investments. What's that going to look like in 2026, do you think?
Yeah, I mean, AI is a huge mega trend, right? You can compare it to the internet trend in the end of the 90s, early 2000s. And I think what we've seen in recent months is that although there's no doubt of this being something that's going to grow and it's going to grow big, the question is around is there being overinvestment? Yeah, how much to invest and when? And we've seen that very clearly from the way the markets have behaved in the past couple of months. So as we were waiting for the results of NVIDIA to come out, the stock markets in the US were in chaos. All the winnings that came across the past months were coming down, coming down, coming down. And they were just waiting for it. It shows how it's so concentrated in just a few companies. One company was able to, the results of one company was able to have that much influence. And you hear various industry analysts saying it's like, we know this is going to be big, but we don't know how we overshot the investment. Is there going to really be as much demand in the market as what we're forecasting for AI? So that's a bit the challenge. I think in terms of the energy sector, the demands on energy are of course being very large, but it's being a great opportunity for clean energy to supply. So coupling these data centers, making them green data centers, connecting them with the renewable energy, that's being something that's good for the energy transition. And it's being a play that a lot of energy players are looking to get into. They're using this as a segue to go into diversified businesses.
Yeah, it's a really important point that because I think often with technologies you require that investment in order to drive forward wider adoption, and perhaps one outcome or a silver lining or advantage even of all of this investment into this is much needed capital is going into renewable energy and finding solutions when it comes to storage, batteries and storage. Giles, I'm going to come to you there because all of these options and essentially renewable energy, the challenges that it faces for emerging markets, for developing nations in particular, they're costly and they're not very easily available. The people they can often get them from. Some are worried about Chinese influence with renewable energy investments around the world and how they're helping developing nations. What role do you think gas ought to play in those countries where adoption of renewable is high? Do you expect the LNG boom to continue in major developing nations, particularly I'm thinking about South Asia, Southeast Asia? Is that demand likely to stay up when the cost solution is so clear for many of them?
Yeah, maybe I'll come to that point in a second. I just wanted to kind of comment on the kind of data center growth and gas demand growth in relation to the US market to start with, because I think for us that is a huge driver in global markets. If you think about the relevance of US LNG in the international market, and what you really see is that with some of the Trump administration's policies with regards to the One Big Beautiful Bill and other policies has really confused the picture with regards to solar and wind investment in North America, and that has then led to the demand-led sort of data center growth turning to gas to meet that power. And so what you're seeing is a very strong growing US gas market, either as a result of demand for LNG exports or as a result of power sector investment as well. And so that is really fueling a gas boom in the US and is starting to impact pricing in that market. I think as you start to turn internationally, it's interesting because I think the international picture in regards to LNG demand is nuanced depending on the markets in which it's operating in. So if you think about probably the biggest growth markets in China and India, actually where gas is sort of focused is in the industrial sectors and the residential sectors, less so residential in India, more so transport. But so gas as a kind of as a fuel for power generation in those markets is not really the main story. It does remain demand growth is either for power is either renewables or it's coal, and gas's role as prices come off is does it compete better into the industrial sector? Does it lower wholesale prices, and does that spur and support industrial growth within those markets? I think in other markets in Southeast Asia, in North Asia, gas has a greater role in the power mix. Lower prices should incentivize that and perhaps provide support for some of the baseload generation there. What we would expect, and indeed what we are expecting, is that with all of this supply coming to market at prices which start to move towards $8 to $9, I think is our kind of medium-term forecast, that when you see gas at that price level, gas will start to incentivize additional power generation growth and will become a greater part of the energy mix in those growing economies.
And just a quick question to get your thoughts. We have seen a lot of geopolitical uncertainty in 2025. I'm thinking about wars in the Middle East in particular, attacks by the US on Iran, and somehow the oil markets didn't really blink, didn't move that much. Do you think that's likely to a new normal moving forward if you compare to what happened with the war in Ukraine and the start of that in February 2022, do you think the markets are just a bit more used to this sort of geopolitical uncertainty now, or is that a complacent view to be having?
I think it depends on the situation and the risks to supply or demand which those throw up. I think they blinked. I'm not sure they kept their eyes shut for very long, though. I think would probably be my view of the situation. And you know, we were watching that, and we were watching prices move around a little bit, but yeah, perhaps not to the scale that it might have done in the past.
Yeah, perfect. Thank you. We've got about 10 minutes now, so I wanted to get some questions in from the audience as well. A reminder, if you do have any questions for our speakers, please just drop them in and we'll try and get to them. But we'll go on to our fourth poll, and it's on global carbon markets, which the presentation Paula outlined at the start focused quite heavily on. What will be the defining feature of global carbon markets in 2026? This is an area I think we've been speaking about for some time, but 2025 saw some key changes, particularly with China and the EU. Do you think expansion and integration of carbon pricing mechanisms will be the defining feature, growth of the voluntary carbon market, technological advancements in carbon removal, or scaling of carbon trading under Article 6 of the Paris Agreement? So just let us know what your thoughts are there. Paula, I've got to come to you on this one. What do you think is the most important factor and why?
I think probably the expansion and integration of carbon pricing mechanisms is probably going to be the defining feature, primarily because some of the others are sort of slow to be adopted or to grow as expected, at least initially. The voluntary carbon market is still, I think, struggling a little bit under sort of what's next. Like I said, it's gotten quite integrated a little bit with kind of what is expected under Article 6 of the Paris Agreement. The Paris Agreement itself has been slow to approve methodologies, not unsurprisingly, really, given sort of the challenges that were faced under the Clean Development Mechanism in Kyoto. I think the concerns right now with carbon markets is that the sort of stability and efficacy of your carbon market is only as good as the worst quality project or credit that you allow to be traded in it. And so if you are not careful with the methodologies and the credits that you actually permit to be in that market, you really run the risk of undermining even better, like good projects as well, and so that's, I think, why people are a lot more cautious about these things than they were before. National carbon pricing mechanisms and pricing schemes are a little bit easier to control because you're looking sort of within national borders rather than an international one. The Article 6, particularly PACM, the Paris Agreement crediting mechanism, which is Article 6.4, that is particularly complex. It might be one of the most complex sort of international trading markets that anyone's ever tried to build in some ways. And so that, just takes time to happen. We now have our first methodology that is approved under there, but it's not a methodology that people traditionally associate with carbon markets. When people talk about voluntary carbon markets, they often think about trees and nature and, biodiversity. It's a methane management project methodology, right? Because those are easier to measure and they're sort of more they're easier to account as well when you're looking at carbon accounting. And so as a result of that, I think that it will be expansion and integration of carbon pricing mechanisms simply because the other three are still a little bit slow to move. But again, we may see a big surge in some of those things as well. But that would be my expectation.
Yeah, and we'll just wait for the results of the poll to come in to see what people thought. But just briefly, if I can, in your presentation, you spoke about standardization. I think that's been the greatest challenge when it comes to carbon markets. Everyone seems to be racing ahead with their own sets of rules. The UN trying to FCCC trying to get the Paris Agreement, Article 6, and all of the elements within that, but it's not really working on an international scale. Do you expect this fractured approach to continue, or is there really hope of standardization?
I think under Article 6, there is probably hope of standardization. The question is how sort of quickly it moves and whether other markets move on as it's sort of moving a little bit more slowly and with a lot more consideration. Like I said, it's easier to manage this sort of standardization on your own national level because every every sort of smaller market kind of has their own objectives, whether that's the rate that they want to decarbonize, the credits that they want to highlight. If you're Brazil, for example, you have a huge hydro balance and obviously quite a lot of wealth of forestry credits. So, right, you might want to build your national carbon market to focus on those. The same is true of other smaller carbon markets that have developed over the course of the last couple of years. You've seen them focus on specific types of credits, whether they're regional, whether they're national, whether they're of a specific type. That's easier to measure than something like Article 6. I do think that you are going to see kind of a broader growth of them, and you will probably see the first real deals on Article 6, I would suspect, coming through as well. But as I said before, the voluntary carbon market could be an instrument for this, but it itself has started to coalesce at least around the terms and the methodology that underpins the Paris Climate Agreement. And so in some ways, it's also a little bit hamstrung in its growth by the recognition and standardization of those rules. So that's why, yeah.
And I think and all of the alternative markets that are popping up, I think, take a lot of inspiration or look towards Paris, the Paris Agreement and Article 6 in terms of where they're adopting rules and regulations. I just wanted to thank you, Paula. We've got a few minutes left. Andreas, I just wanted to come to you, sticking on this issue of carbon markets and what governments are doing, because you're based in Europe, and the European Union has faced some backlash, worries about the dampening investment. Lots of energy firms have spoken about the European border adjustment mechanism. They say this is to try and drive forward sustainability. Do you think that that's going to be an issue when it comes to policy regulation about going too hard, too fast, and the impact it will have on investment at a time when global economic growth could be slowing down?
No, no, as you mentioned, indeed, what we have seen is a renewed approach towards managing, security of supply, managing geopolitical challenges that have been emerging, and becoming much more complicated over the past few years, and at the same time promoting the broader energy transition agenda. Definitely, we're seeing all policymakers becoming a bit more cognizant to this trilemma, if you like, and at the same time, the way also the players in the market react, they do start expecting a different level of balance among these elements. Definitely, when it comes, for instance, to security of supply, we do see expectations that the policymakers will definitely place increasing attention on this part of the equation. Broadly speaking, there is, of course, still a lot of regulation. Definitely there needs to a lot of clarity is still necessary that needs to come in place when it comes to energy transition related regulation. And a lot of technical issues, for instance, to questions around CBAM, as you were mentioning before. How exactly is it going to be administered, and how our envelopes and perimeters are going to be drawn to make sure we don't allow, that you don't offer the opportunity to circumvent the regulation. So a lot of questions about how everything is going to be administered, how the regulation is going to be airtight, and how quickly it's going to be rolled out is what we definitely see across the board.
And definitely something that we'll be watching in 2026. Paula, very quickly, if you want to, please, because we've got to wrap up in a couple of minutes.
Yeah, I just wanted to add to that as well, I think to build on Andreas's point. The ETS is under review in 2026 as well, which is going to actually probably have pretty significant repercussions about sort of how these kind of harder to abate industries are going to adjust over the course of the next couple of years. So that's going to be something to also watch pretty significantly, that combined with kind of the overall decarbonization target, the role of carbon credits, et cetera. The EU is really actually in a bit of a transition point here in a way that's been under discussed as well.
Yep, and I think the highlighting that point is the fact that the European Parliament recently voted to really streamline some of those regulations as well, or at least make the hurdles much higher for businesses that it does apply to. But that's all we've got time for. I'm going to give you the results of the final poll, which is why I've been looking down at my phone. As you said, Paula, the audience agrees 60% nearly, 57% thinking expansion and integration of carbon pricing mechanisms will be the defining feature for carbon markets next year. Nobody thought the voluntary carbon market growth would be, and then 30% nearly thinking technological advancements in carbon removal would be the defining feature, and leaving 15% thinking scaling of carbon trading under Article 6. But that's just about time now. And thank you so much to all of the panelists for really engaging, insightful discussion. As we said at the top, hopefully it will help you look at what's been important this year, the key developments, and what to watch out for next year. So thank you once again for all of my panelists: Andreas Kyrilis from Bain & Company, Faysal Taher from BCG, Giles Farrer from Wood Mackenzie, Norela Constantinescu from IRENA, and Paula Van Laningham from LSEG Data and Analytics. And thank you, of course, for attending this webinar series supported by the Al-Attiyah Foundation in partnership with LSEG Data and Analytics. We look forward to welcoming you to future webinars. And if I could just leave you with a final note, please, encouraging you all to fill out the post-event survey, which will be shown on the screen in a few seconds, or can be filled out on the same event page as well. Thank you again, and goodbye.